Hey everyone, welcome back to Corporate Decoder. Today, ADGM just filed a notice of delisting or failure to satisfy a continued listing rule, and I am seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. Adagio Medical is facing delisting from Nasdaq due to not meeting the minimum bid price requirement, and this could be a wake-up call for the company. So what exactly happened here? Adagio Medical Holdings, the company we are looking at, received a notice from Nasdaq. This notice basically says their stock price has been too low for too long. Specifically, the stock has been trading below $1 per S-share for 30 consecutive business days. This is a problem because Nasdaq has rules about minimum bid prices to ensure a certain level of investor interest and value. It is like a minimum entry fee for being listed on the stock exchange. The company's full name is Adagio Medical Holdings Incorporated. They are a medical device company. Even though this notice doesn't mean they are delisted today, it is a serious warning. They have been given a grace period, a chance to fix this problem. The date of this event when they received this notice was the 12th of June 2026. This is the starting point for their compliance period. According to the filing, they have 180 calendar days from this notice to get their stock price back above $1. That brings the deadline to the 9th of December 2026. During this time, their stock will still trade on the Nasdaq capital market. The specific rule they are failing to meet is called the minimum bid price requirement. It is pretty straightforward. The stock needs to close at or above $1 for at least 10 consecutive trading days to show Nasdaq they are back in compliance. Imagine trying to pay back a debt, you have a deadline to clear it, and if you do, you are good to go. If not, there are consequences. The shares that are affected are their common stock, which are essentially the basic shares of ownership in the company. Currently, these shares are trading below that critical $1 mark. Looking at the context, the stock price is around 70 cents to $2.58 over the past year, and currently trading around 75 cents. This means they have been flirting with this $1 threshold for a while. Adagio Medical is also an emerging growth company. This means they are a newer company and have certain regulatory flexibilities. However, it does not exempt them from basic listing requirements like the minimum bid price. There is also a checkbox here indicating they have elected not to use the extended transition period for complying with new or revised financial accounting standards. This suggests they want to stay on top of accounting changes. This part confirms the official notification from Nasdaq. Nasdaq is the exchange where Adagio Medical's common stock is listed. It is important to understand that Nasdaq is the gatekeeper for listing companies, and adherence to their rules is crucial for maintaining that listing. When a company fails to meet these rules, it signals potential underlying issues that investors should pay attention to. This reiterates the compliance period and the specific rule that grants them this time. If they fail to meet the price requirement by the 9th of December 2026, things get more complicated. Nasdaq may offer a second 180-day period, but this comes with conditions. The company would have to formally tell Nasdaq they intend to comply, possibly by doing a reverse stock split. A reverse stock split essentially combines existing shares into fewer, but hopefully higher priced shares. Think of it like exchanging 10 $1 bills for one $10 bill. The total value stays the same, but the per share price increases. Many microcap companies that end up doing reverse splits often face delisting down the line. For example, Kodak did a 1-for-20 reverse split around 2021, and their stock eventually got delisted. Historically, about half of microcap companies that do reverse splits end up delisting anyway. The company states they are looking at all options, which is what you would expect. The most common strategy here is a reverse stock split. However, there is no guarantee they will succeed. If they don't meet the requirement even after that second chance, Nasdaq will initiate the delisting process. Delisting is a major blow. It means the stock will no longer trade on Nasdaq, making it much harder for investors to buy or sell shares and severely damaging the company's reputation and ability to raise capital in the future. Finally, the report is signed by Deborah Castor, who holds dual roles as Chief Financial Officer and Chief Business Officer. This is standard procedure for such filings, indicating responsibility for the information provided. Now, let's talk about what this means. Adagio Medical is a healthcare company focused on medical devices. With about 41 employees, their market capitalization is around $17 million. This delisting notice comes at a time when their stock price is already quite low. As we saw, a low stock price can be a symptom of underlying business problems, or it can sometimes be a temporary market condition. However, for a company listed on a major exchange like Nasdaq, sustained low prices are a major concern for investors and the company itself. The company has some significant institutional investors like Perceptive Advisors LLC holding over 44% of the shares, and CO Capital Management LLC with nearly 6%. These large holders are watching the situation closely. If the stock is delisted, it can make it very difficult for them to manage their holdings. The fact that they are on the cusp of delisting due to a low stock price is a serious signal. While they have a chance to rectify it, the situation highlights potential challenges for the business. It could be related to sales, profitability, or investor confidence. Investors should be viewing this with caution. The risk I am watching is whether the company can actually execute a plan, such as a reverse split, without further jeopardizing its financial health or investor relations. My biggest concern is that if they can't maintain the minimum bid price, it might indicate deeper issues with their business model or market competitiveness that a simple stock split won't fix. What I am actually looking for is a clear, viable strategy from management beyond just a financial maneuver to stay listed. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.